All right, welcome everybody. This is the State of the Union for July 2020. So this is your monthly real estate market update and economic recovery update. So the purpose of this, if you've never watched this before, is really just a macro level overview of the economy and the real estate markets, just to keep everybody up to date and informed on what is happening out there, right? So this is something I do monthly. It's in conjunction with the Mach 1 report that comes out monthly as well. Typically, I do this as a live webinar, but due to a bunch of things this week, I decided to pre-record it. I had strep throat last week, so I couldn't talk or swallow or anything. It's pretty brutal. So I decided just plan on pre-recording it and get it out there since it's already a bit late due to my illness. So here it is. Let's get into it. So a bit about myself. Grew up north of Boston, so I'm about 2 hours north of where I grew up. Now I'm actually in New Hampshire, Lake Winnipesaukee. I have a lake house up here on an island, so I thought it would make a nice little backdrop for today. You can kind of see the lake there in the background. It's a gorgeous place, and I've been fortunate. I've spent the last month up here just working from home, right? But I'm flying back this Friday. Unfortunately, the good times are coming to an end. Time to get back to the real world a bit. It's tough to get work done up here. I'll tell you. It's a big distraction behind me, So it's tough to pass it up a lot of sunny days. But yeah, that's kind of, I guess, the advantage of COVID is everything is shut down. So it afforded me that opportunity to just come up here and kind of hang out for a bit and live the dream, right? That's the advantage of real estate. That's one of the reasons I got into real estate, was to have that personal freedom to be able to make my own decisions. And I don't have a boss that I answer to. So if I decide to come out east for a month, I just do it, right? So that's the essence of freedom right there to me. All right, out of high school, I got a ROTC scholarship, so I went into the Air Force. Ended up tracking aviation and eventually flew B-1 bombers. So that was the jet I flew during my career. I amassed about 2,500 hours in that jet, and I got about 1,500 combat hours over 3 deployments to the Middle East. While I was still active duty, I started investing in real estate. So I house hacked in Rapid City, South Dakota, got a duplex, and that was my first experience of, really someone else was paying my bills. My mortgage and a lot of my utilities were paid for through the rent. So it's an addicting feeling when you start to realize that, hey, every month the cash keeps coming in, that mailbox money keeps coming in every month, and it's almost on autopilot, right? I mean, there's still a lot of work involved with owning real estate and rental property, but it's that consistency really is, in my mind, makes it an unmatched investment. So I'm also fortunate that I'm an early crypto investor. I got into Bitcoin in 2013, paid for this lake house, not tagged, but it's been really good for me, and it looks like we're starting to make another run. So I'm really hoping Bitcoin explodes this year, because that'll be perfect timing to put that money into real estate and really grow my wealth in the long term. So with that, I founded Mach 1 Equity last year, and I've been doing that ever since. It's been a lot of fun growing that. Actually, some updates of the last week. I've actually hired 2 employees, so I've got a social media manager and a cold caller, someone to just hammer the phone, call property owners or potential sellers or buyers, even for my Colorado project. So that's been a fun development, and I've been working with them for the last week or two, training them up, and I think it's really going to lead to big things down the line. All right, so let's get into the economic update. So here we are. This is the June jobs report. So we added 4.8 million jobs in June. So that was a huge report. That was very positive. The expectation was only 2.9 million. So it crushed the expectations, and that was a really positive indication that the recovery is progressing. The biggest gain was in that leisure and hospitality sector, hotels, things like that, tourist destinations. So they gained 2.1 million jobs in June, which is about double what they grew the month prior. So all said, they've gotten back about 3 million jobs, maybe a little bit more. but they're still down 3.1 million jobs from where they were at the start of COVID. So that sector still has a lot of ground to make up, and that's true of really all sectors. Retail also was a big winner. They gained about 740K in jobs, but they're, again, still down 1.3 million. So it shows that we're making strides, but we still have a lot of ground to make up, okay? Unemployment dropped to 11.1, so it dropped about 2.2%. So it's, the expectation was 12.5%. So we beat that. So again, another positive indicator. But a couple asterisks with that, the Bureau of Labor Statistics that puts out that monthly jobs report, they reported by their own admission that it's probably closer to 12.1% because of reporting errors and just errors in their data and their processes. So a little caveat there. I also put down the true unemployment rate. True. So there's different unemployment rates that are reported by the government. There's like 4 or 5, and there's different categorizations for what qualifies for the different unemployment rates. So what I'm putting there, that U6, that true unemployment, that includes your discouraged and your underemployed workers. So a lot of people feel like that's a better indication of where the jobs market is on a whole, and that's at 18% right now. So it dipped 3%, so it's still a strong recovery, but I mean, you still see we have a long ways to go. When we went into COVID, remember the unemployment rate is 3.5%. That true unemployment was probably about 6 or 7%. So we still have a long way to go with this recovery. All right, looking at unemployment claims. So this is also a good way to get a handle on the jobs market, because what's interesting is if you look at just the jobs report, it's going to be a little bit misleading compared to other reports and data that's available out there. So according to the BLS and the unemployment or the jobs report, we have about 18 million people unemployed, but that doesn't really check with reality because it doesn't include a lot of people. So this is why I put this here. You know, an estimate of about 30 million people still unemployed. With that, what we're seeing in late July is actually claims are going up. So continuing claims are increasing. They're up about 140K week over week. So that's a bad sign. That means job losses are becoming permanent. So a lot of people that thought they were just going to be temporary layoffs are becoming permanent. And then also what we're seeing is some of the stimulus programs, the PPP and the EIDL, that was keeping a lot of people on the books, keeping a lot of people employed, that stuff is starting to run out, is starting to dwindle. So those people are starting to join the unemployment lines, right? So you can see that chart on the right there. That is the weekly unemployment claims. So the latest week, it was still up at around 1.5 million per week. But you can see that doesn't include that red bar is pandemic unemployment assistance. So that's your gig workers, your self-employed people. When you account for that, it's like 3 million people in a week, right? So the total, I guess, if you go back 16 weeks, it's about somewhere around 50 million. So that's a considerable amount of people, right? And as we said, we were trending down, but now we started to level off. So this is where we start to see the signs that the economic recovery maybe isn't as strong as we were hoping. We're not seeing that V-shaped recovery. This is going to be a little bit more drawn out to recover. And of course, the big issue with that is that Congress right now is impotent, right? They're not really making any moves. That unemployment is running out. The $600 a week benefit that the federal government was subsidizing on top of unemployment insurance is no more. That expired July 31st. So the problem with that is that's one of the most effective ways to stimulate the economy, is that unemployment program, because it puts money directly in the hands of the people that need it the most. And what they do with that money is it doesn't just go into their savings account. They're out there spending it. They're spending on rent, groceries, clothing, whatever, gasoline. So that money is getting right back into the economy, and it's stimulating, it's really propping it up. So the economic situation for the last couple of months has really been held afloat by this unemployment program. and that extra $600 a week, and even the $1,200 check that went out a few months ago that most people have already forgotten about because that money's long gone. That's been propping up the economy so far. And it really gets into this next slide, which is consumer spending. So consumer spending, that makes up 70% of the economy. So at the end of the day, I kind of think all roads lead to consumer spending. If we want to recover from this economic depression, recession, whatever, we need to see consumer spending recover completely. Otherwise, we're still not out of it, right? So what we have been seeing over the last couple of months is a decent rebound in May of about 8.2%. So that comes on the heels of a 6.6 drop in March and a 12.6 drop in April. So those were like the record drops. You never seen anything like it. You can see that chart to the right, which is total consumer spending, and the zero line, the 0% line, is basically January 2020. So that we're using that as the mark point. So we're saying right now, if you look at the chart, we're about 9% below what we were spending as a nation back in January, right? So that's the deficit. We did see some additional positive signs in retail sales. So those were up 7.5% in June after a 17.7% bump in May. So that was a record bump in May, and 7.5% was still a huge bump as well. So we are seeing signs of recovery. Things are getting a little bit better as the local markets open up. Of course, a lot of this is going to vary based on states and metros because they have different policies, and largely the social distancing that was going on is the first portion, they call it the first month or two of the pandemic. That was what really was sucking down spending. That's where you see that huge drop in April, because people just weren't going out. They weren't spending money. They got all their groceries in March, and then they were just kind of riding it out at home. But now you see signs of life, and it's not just from businesses being shut down. It's just people actively were staying home to avoid being out in public, right? So like I said, the last month, spending is up across the board, so that's very positive. But you can see in that chart, if you look at different categories, those are kind of your major spending categories. We're still pretty much in the red for most of them, some more than others. Arts and entertainment is still down 50%. So still have a long ways to go. Transportation still down 50%. You can see grocery and food stores, those are actually up 7-8%. People aren't going to restaurants, so they're buying more food at the grocery store, right? But as we continue forward, as I mentioned before, those unemployment programs are starting to run out. The time is up. People are no longer getting that $600 a week benefit. The EIDL, the PPP is running out, so more people are going on unemployment. So we're going to start to see those gains soften, and that'll diminish as the stimulus diminishes. So that's why I said Congress really needs to step up and do something to put money into the hands of everyday people, these hourly wage earners that all lost their jobs. Without them coming back into the consumer marketplace, basically, it's going to be a real challenge, because at the end of the day, spending recovery is really the key to the economic recovery. So that should be the focus right now, is improving this. So one thing I did as well this month was that was more the macro level US, but if you look at specific markets, there's published data out there. This is from, I think, smartasset.com. They put out a little mini study about specific markets and how they've fared in terms of the recovery of consumer spending levels. You can see there's the top 10 markets for consumer spending recovery. So I really like this, because if you're looking at markets to invest in, this is a great thing to look at, is what are the cities that are going to perform really well throughout the downturn. And you can see what cities overlap with markets that are good to invest in real estate, right? So you may not be looking in Detroit or Boston to invest in real estate, but the last 5 years, Boise has been blowing up. Salt Lake City in Utah is also very popular with real estate investors. And maybe you look at, hey, Wichita, Oklahoma City, what's going on in those cities that the spending is recovered so strongly. So here you can see to the left, we got the top 10 again, and then it just shows the details there. And then you, on the right side, you've got the bottom 10 markets in terms of the consumer spending recovery. So the way that this data was compiled was they did the list of the top 51 cities, and then they weighted them based on the percentage point recovery and the where they are in terms of their current consumer spending compared to January 2020. So the number one there was Detroit, negative 1.8% remaining to recover, but they've also recovered 39%, which is greater than some of those other cities that didn't drop as much. Because you can see some like cities like Boston, they dropped 54%, but they've recovered 48%. So that maybe is worth a little bit more than Philly that was starting at 39%, right? So, or Boise that was starting at 31%. So you can just kind of take a look at that data and kind of glean some insight from it. Of note, kind of an honorable mention in this month's report was Jacksonville, Florida has recovered 100% of their consumer spending. So that's a good example. That's a market that I'd always heard of from certain investors like Jacksonville. But now that I see, oh, they've recovered 100% of their consumer spending, what's the story behind that? And is maybe that's something that will really push it over the edge over some other markets to invest in going forward, because they could perform really well throughout the downturn. Or maybe that was just a fluke. They had some sort of, you know, you'd have to look into why that is. Maybe they just ignored the whole COVID thing and were out at restaurants and bars and nothing really changed. And now that the pandemic is sweeping the city, who knows? You'd have to look into it, right? Okay, changing gears a bit. So let's get into the real estate market update. So for the housing market, a lot of positives here. So new home sales up almost 14% month over month. So that brings the seasonally adjusted rate up to 776,000 units being sold. That's up about 100,000 from where we were last year. That's the highest level since July 2007. So new home sales are very strong right now. Existing home sales also up almost 21% month over month. That's the largest increase since they began reporting this in 1968. And that brings the adjusted rate up to 4.7 million units for the year. So you can see home sales really strong, really bullish. Existing home sales in June, they're still down 18% from a year ago, but the demand is really strong, and that is pushing the median home values up. So we've actually seen a 3.5% increase in home prices from a year ago. So that brings the average median home value to about $295 across the country. Obviously, that's very market dependent. So some of you may be thinking that is super cheap, and other people might think it's expensive or right on the money. So it depends where you're living, right? But overall, home sales are still down almost 11% from a year ago. But like I said, the listings are down. So because listings are down almost 18%, that's pushing demand supply balance kind of out of whack, and that's what's driving home prices to continue to rise throughout this pandemic, which surprises a lot of people, but it makes sense when you back up. Housing starts are also up 17% month over month. So they beat the forecast by about 20,000. Multifamily starts also surged about 18.5%. So the starts are looking really strong. Single family starts up 17%. So overall, they're down still about 4% year over year, but they've recovered a lot from the first month of the pandemic when people got a little skittish to build. Permits also are up 3.5%, and you can see the comparison. Single family is up 12%, but multifamily is down 11% for building permits. So some projects may be still being delayed or put on hold as people are just being cautious as they move forward. Mortgage rates averaging about 3.2% for the week ending July 17. So that's also these all-time low mortgage rates is driving demand from first-time home buyers. I also heard some rumors that there's some talk among some congressmen about providing a one-time credit or a one-time incentive to first-time home buyers where they can withdraw money from their IRA tax-free if they're using it towards the purchase of their first home. So I thought that was interesting just because demand isn't really an issue right now, and yet that is something that is being discussed on the Hill to prop up demand from home buyers to help people buy homes. So I thought that was interesting because right now there's still just a lack of supply out there, but that could increase demand even further, which could drive prices up. All right, switching gears a bit, looking at commercial multifamily specifically. So multifamily has performed really well throughout this whole pandemic, but we are seeing some slight signs of weakness in July with rent collections. So up through the 20th, collections were about 91.3% compared to last year, they were 93.4%. So if you look at that, that's a 2.1% decline, which doesn't sound like a lot, but it adds up, right? If you have 100 units, that's 2 units that aren't paying that month, right? So that really adds up and it eats into your returns as your delinquencies rise. So if you look back at the last few months, if you look at just going back to June, June was even Steven with where it was a year ago. Compared to July, we're seeing that dip. We did see dips in April and May, but I think that was a lot of that was just because the pandemic was just starting. It was so new. A lot of people were just starting to lose their jobs and go on unemployment, and there's some delay. There was a lot of delays of people getting their unemployment. So overall, I think those months fared a lot better than people were expecting. And then, like I said, June was right on the money. So now that we're starting to see a bit of a dip in July, I think we'll see going forward further declines in August, and especially I think September is going to be a big month to really test that microeconomy, because if Congress doesn't step in and provide additional unemployment or something, those 30 million people that are out of work are going to not be able to pay their rent. So we could see a sharp pickup in delinquencies. I'm not going to guess a percentage, but I think we'll see the collection rate diminish. Really, I think September is the first test because that's a full month after their enhanced unemployment runs out, right? And I think that'll kind of snowball throughout the economy with, you know, the second, third order effects gonna make things a lot worse. Overall, rent is also beginning to flip. So rent's down $2 in June, doesn't sound like a lot, 0.7% since May, but overall it's down $12 since January. And this is the first time year over year rent has been down since 2010. So it's down almost half a percentage point. Class A is down further. Class A is the first to really start adding concessions and cheapen their rent to try and get tenants in, because those tenants often flee to Class B properties when times get a little tight, right? So Class A is going to kind of drive the dip in rent growth. Coastal and gateway markets, those are going to be harder hit. So your expensive markets like San Francisco, Boston, you know, probably Houston, those are going to be where you see bigger drops in rent compared to your Midwest markets, which are going to be a lot more stable. So you can see this chart to the right. That's your top 10 markets for the last 2 months for rent growth. You can see at the top there, Portland, Maine, kind of a surprise, 1.7%. I'm actually about 90 minutes from Portland, so I'm going to try and take a look there this week before I head out of town. it's interesting. It's a really hot market right now. It's a couple hours north of Boston, so people fleeing that more expensive Boston market for Portland, Maine, driving a lot of growth. And then you can see really kind of down the line, those are all more Midwestern markets, right? So Huntsville, Mobile, those are popular places to invest. Huntsville is one of the markets I'm looking at right now. Columbus is a popular place to invest. So when you see these types of things, that's a clue, right? That these are strong markets to invest in, because even when times are down, their rent is still growing. And you can compare that to the bottom 10 markets. Like I said, those more coastal gateway markets, Boston, LA, Denver, San Diego, these larger markets. Midland, Odessa they kind of had a double whammy because of the oil industry fallout. So they're down a staggering 8.6%. So those are pretty big rent drops. That's a big reversal overall from what we were seeing as we went in 2020, right? So, all right. So that's kind of the macro level update. Like I said, just stay tuned for the next couple months. We could see some weakness in the multifamily markets, which that could be where the opportunity comes from, right? So as that occupancy dips, we could see some price adjustments, and it could be a good time to pick up property. I just don't think it's really hit yet. Real estate just takes a while. This is a current project of mine. This is going on in Loveland, Colorado. This is a medical office development. It's already closed out, but just like to share this if no one's seen it before. It's a fun one to talk about. It's a little different, a little interesting compared to what you often see, which is multifamily or mobile home parks or something. So if anyone wants to chat about that, I'm always open. And then this is, like I said, this brief goes in conjunction with the Mach 1 report. So that's live up on the website. You can go to mach1equity.com/economic reports, or just follow the link at the top of the page to economic reports, and you can access the hard copy of this for reference as well. So that's all I got for you today. Thanks for tuning in and joining me. There's my information. If you want to reach out to me, you can set up a call on Calendly. We can talk about investments or goals or whatever, or just shoot the shit and get to know each other. So highly recommend. Definitely reach out to me if you haven't already. Love expanding my network and talking to new people. So thanks for joining, guys. Take care. Happy investing.